Hello, and welcome to the December 2023 Economic and Market Update, presented by Commonwealth Financial Network. My name is Brad McMillan, and I'm Commonwealth's Chief Investment Officer. After a couple of down months, markets roared back in November as interest rates dropped back to September levels. The U.S. indices were up by high single to low double digits, from 8 to 11%, with the Nasdaq doing the best. International markets also rose sharply at almost 9% for developed, and with emerging markets up by about 7%. Even fixed income showed surprising gains of between 4 and 5%. Everything went up. The main driver of the gains was interest rates, which pulled back as signs the economy was slowing popped up across the board. Inflation continued to ease on that slowing, and increasingly the Fed looks more and more likely to stop hiking rates. At the same time growth was slowing, though, there were signs it would keep going, but at a more sustainable rate. Job growth dropped, but only to typical pre-pandemic levels. Consumer confidence edged down, but still at a healthy place. Consumer income and spending growth slowed, but stayed positive. And the list goes on. And this combination of slower but continued growth and lower inflation combined to suggest the economy is heading for a soft landing rather than a recession. And both interest rates and markets have responded. Overall, despite the slowing, we're still in a pretty good place economically. So with the economy solid, the real question is whether inflation will keep trending down. Signs are it will, primarily due to the housing market, which is still weak. Housing is a key contributor to inflation. As that downtrend continues, the overall inflation number should keep improving. There are risks, of course. Inflation could accelerate again, and the slowdown could get worse. Beyond the economic risks, international factors are still real potential problems in the Middle East, in Russia, and in China. We still have a wide range of threats to contend with. But despite those very real concerns, there are also some bright spots. Earnings came in better than expected this quarter and should keep growing. The decline in interest rates last month should help support valuations going forward. And with 1 month to go, strong years tend to finish on a positive note. With the economy in a sweet spot and with earnings growing, the market foundations are still in good shape. None of this is guaranteed, of course, and risks remain, but as we rebounded in November from a couple of bad months, there may well be some running room here, especially as the fundamentals are still solid. That's it for this update. Thanks for watching. Join me next year. Yes, that's right, next year, for the next one. But until then, be sure to check my blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. And I hope you have a great holiday season and a very happy new year.